Let's start with the shilling. As I said, 13% stronger against the dollar from its low of 107. The market liquidity in the market is tight, and that appears to really be helping the shilling appreciate at this point.
Absolutely, we've got a much higher interest rate regime. Overnight rates in the interbank market are at 30%. And risk reward, it's beginning to suck in a lot of cash into the shilling. So we've seen this, as you said, sharp rally of about 13% in just over a month. But however, the question remains, can the economy sustain this enormous surge in interest rates? We've gone from rates of around 14% to retail borrowers to around 26 to 30%. And really, the jury's out as to how long the central bank can sustain these sorts of rates and how long the economy can wear it.
At the same time, whilst we've got borrowers suffering, you've got the cost of lending, which has surged quite substantially this year. You've also got the concerns around inflation once again coming to the fore with the fuel price increase. So the conundrum for the Central Bank of Kenya becomes even harder.
Absolutely. I mean, the central bank were essentially between a rock and a hard place. Part of the reason was, I think, they were desperately trying to keep growth intact. Earlier on in the year, they cut rates, which just caused a huge flight out of the Kenya shilling. And I think they've just had to bite the bullet under the auspices of the IMF, who, of course, slotted us $750 million. But I think a quid pro quo was a much tighter monetary policy. Essentially, the optimal outcome is that we see inflation ebb quickly. But as you've noted, fuel prices were hiked up higher again, which further delays the turning point in the inflation rate.
Let's move on to some market news. We've got National Bank of Kenya reporting its results. They were out yesterday. Pre-tax profit down 9% for the first 9 months to 101.8 billion shillings. The bank chose to take a hit on its loan book, reducing that loan book to 1.88 billion from over 11 billion shillings, and that appears to have hit the bottom line.
Absolutely. The National Bank wasn't really a big player in the lending market. It had a very outsized government of Kenya bond portfolio, and they've essentially lost it, and the size of the position was 10 billion shillings. We've had a huge move in the interest rate market, as we were earlier alluding to, and they've chosen to take the hit on the chin, and I think that's essentially what those results are telling me.
Operating expenses up some 26%, more than double the rise in income, which was up around 12%, but loans and advances surging some 52%, so they're not able to translate that new business into income that outpaces the growth in expenses. Perhaps a red flag there.
Well, I noticed that big increase in operating expenses. I haven't been able to drill into the exact reason. I think obviously they're trying to re-engineer the bank away from the bond market and into lending, and that might have incurred a lot of personnel costs, but I'm not privy to what exactly led to that increase of 26%.
Let's focus on the banking sector in general. We've got Equity Bank sitting as the most expensive lender, 25% lending rate at this point. Standard Chartered at 23%, Barclays Bank at around 22.5%, but all these banking rates have shot up quite substantially. Of the banks, which do you feel are least vulnerable to losing out in this tighter interest rate environment and have the most resilient business model?
That's quite a multi-sided question. I think, we've got to strip out those banks. We've got to strip out risk two ways. We've got to look at market risk, and the likes of National Bank obviously have taken the market risk right down. And we've got to look at credit risk being the lending to customers and the types of lending these banks are doing, and whether customers can sustain a 10% increase in borrowing rates, and whether we're going to see a significant spike in delinquencies. I think you don't have to be a rocket scientist or a banker to know that we're surely going to have a big spike in delinquency rates. So when I look at that context, I think the most defensive bank has been actually Barclays. Barclays have trimmed their lending book. They've been much more cautious for quite some time now. KCB, I think, similarly have taken a similar approach, although they've grown their mortgage book, but that's secured against housing. So I think that's going to be relatively less risky than other types of lending. I think mid-tier banks have supported mom-and-pop construction builders, people who really didn't have that much capital except the land collateral. And in those sort of areas, the anecdotal chatter is that there are going to be a lot of problems down the road. So on balance, I would stick with the big blue chips for now, with a bias towards Barclays and KCB, which are both pretty cheap on a price-earnings basis.
Let's move out of that sector, looking at the investment sector. Transcentury looking to diversify its exposure away from the power sector, which it has, about half of its revenues coming from East African cables, looking to buy an engineering firm. What do you think of this diversification, a wise move on their front?
Yes, I do. I think it's quite interesting. The biggest bet Transcentury have really got is on the railways, and that's their position with Citadel Capital, Ahmed Heikel's company from Egypt, where they've partnered up to try and unlock the Lunatic Express 100 years later after it was built. And I think that's going to pay off, but it's going to pay off in the medium term. And I think this acquisition of Civicon is part of the same sort of business. It's adding on similar type of expertise. There is a construction boom going on in the region. They do have a very good position in the power market, and I think it all ties into their strategy. So I, for one, think it will be probably earnings accretive from the get-go and looks a clever bolt-on acquisition. So
good move on their front. Aly-Khan, before I let you go, a stock pick for the day.
Oh, for the day, it's a little bit tricky. The market has turned a little bit lower, trades a little bit softer. But I like the looks. I like the looks of KCB on any pullback. I like Barclays at these sort of levels, and I think trade a little bit defensively for now. EABL, I think, little downside, plenty of upside, and a very interesting story to tell as well.